Okay. Good afternoon, everyone. And if you heard our final technical rehearsal, we apologize. My name is Barbara Henry, and I am the Executive Director of the NSHSS Foundation. And I'm thrilled this evening to have our special guest with us, as well as a member of our Collegiate Council, which is one of our leadership groups here at NSHSS. She's here to introduce our speaker, but this is Money Matters and Career Paths, and it's being presented by the Securities and Exchange Commission, and we're so thrilled to have them as our special guest. So I'm going to let Kiara Morrow from Center College take it away and introduce our special guest, and we will hope that all of our technology issues are in the past and that Nicole will be able to share her slides, and if not, we'll pivot and see if I can help her. So thank you all for bearing with us and being with us this evening. We'll be using the Q&A. If you have any questions as Nicole goes through her presentation, feel free to add them to the question and answer area at the bottom of your screen, and I will help her as we get to the tail end of the presentation to help answer as many of those as we possibly can. Thanks again for being with us. And Kiara, it's your turn. Take it away.
Okay, hi guys. My name is Kiara Morrow. Sometimes people call me Kiki, so it's up to you. I go to Center College in Danville, Kentucky, and my intended major is biochemistry, and I plan on double minoring in health and medical study and French. Now, I'll also talk about Miss Nicole Shea. She is an outreach and engagement specialist in the U.S. Securities and Exchange Commission's Investor Education and Advocacy, where she showed engagement, social media, and investor outreach. Prior to joining the SEC, Nicole served as the Digital Engagement Director at the U.S. Department of Health and Human Services in the Office of Assistant Secretary for Public Affairs. She has also worked at the Consumer Financial Protection Bureau, AARP, Getty Images, and National Geographic Magazine. Nicole is a graduate of Villanova University and lives in Washington, D.C. So without further ado, please assist me in welcoming Nicole Shea.
Thank you so much for that great introduction. I'm really excited to be here today. As Kiara mentioned, I'm Nicole Shea. I work at the U.S. Securities and Exchange Commission, which is quite a long mouthful for an organization. And I have worked in the past at the CFPB, Getty Images, AARP, and I started out my career at National Geographic Magazine last century. I was there for 6 years and sort of started out my career in communications and visual communications there, and somehow ended up at the SEC. So Barb, I'm just looking to see how I could share my slides. I don't know if maybe control needs to be handed over to me. So we've been having some technical issues that I like to think are just completely beyond our control, folks. Sometimes it's a little tricky when I join from a government computer on some of these meetings. It can be a little bit hard to share things. So if you could just bear with us 1 second while we look to see how we can get the slide set up for us to go. But Barb, I can also I'll start just giving a little bit of an introduction about myself, and we have a disclaimer that we give. So today's presentation is on money matters, and I'm going to talk a bit too about career paths at the SEC. So we'll talk about what it means to build a wealth mindset, and the power of compound interest, particularly when you're starting out early and you have many, many years of earning potential ahead of you, and how compound growth can help you meet your financial goals. And we will also talk about, briefly at the end, the red flags of fraud and how to spot fraud. The thinking there being that if you're spending a career working towards building up your saving and investing to have a nice nest egg, that you want to make sure that you're protecting yourself and your retirement savings from someone taking it. So I am really sorry. I'm still not seeing how I could share
Oh,
my
boy.
slides here.
Let's see.
Sorry, everybody. I don't see.
Is it? No, something's happening.
I see someone's getting ready to share. I wonder if I can ask from you.
Yeah.
This has happened before when we've been on. Ooh, sorry, I'll go off video so you guys don't have to see me twice. Come back on.
See if you can, if you can now, Nicole.
I'm looking. I'm not seeing where I can share. I'm really sorry about this.
Okay. Is there a way for me to possibly show your slides and then you could talk?
Yeah, so
maybe?
I've sent, yeah, if you could show them and I can talk through them. I don't know if it would allow, I don't know if I'll be allowed to advance them or not either, but I can definitely talk through them that way.
Let's
Sorry,
see if I
everybody. So there's a disclaimer that I need to give at the top. So I'll go ahead and give the disclaimer now that I'm giving this as part of the SEC's Office of Investor Education and Advocacy, and I'm providing this as information for basic investor education, but this is not a statement of official SEC policy, and nothing that I say should be considered a legal interpretation or investment advice. That's just a disclaimer that I am required to give. I am not a lawyer, so you definitely do not want to think of anything that I'm saying as legal advice. And in today's presentation, we're going to talk a little bit about the SEC, careers at the SEC, making your money work for you. We're going to go over the relationship between debt, saving, and investing, what it means to build a wealth mindset, the power of compound growth, and protecting yourself from fraud and scams.
Nicole, are you all seeing your title slide?
I'm not. When I talk, I'm seeing myself twice, and when you talk, I'm seeing you. Sorry,
Kira,
everybody.
are you able to see the slide or no?
I can see the slides.
You can? Yes.
I cannot.
Okay. I'm not sure what to do, Nicole, because I can't seem to get it to come up either.
Huh.
I'm trying.
Kira,
It's
are you
just
seeing
it's
anything where it would allow you to present?
It lets me
it's
share my screen. It says share screen at the bottom.
Yeah, I don't
Yeah,
have the share screen.
yeah, it's saying that you have the control, but it's not allowing it.
Huh.
I'm so sorry,
This has
everybody.
happened before. Shoot.
Let's see, allow. I'm looking to see if there's any other show last viewed and show. Gosh. Let's do one more. I'll do one more try.
So I'm able to see your screen now.
See, maybe I can just open it this way, which is not usually how I would do it, but it's opening it, I think. Can you see that?
Yep. And it looks to me now like it's in full slide mode.
Okay.
I can see it as well.
All right. Sorry, everybody. Thank you for sticking with us.
Okay. Well, we can go here this way if you
All
want.
right. All right.
You'll have to say advance the screen because
I
I
know,
won't
sorry
know,
about that.
of
Okay, do you
course.
want to, let's get to slide 4 and I'll start to talk a little bit about the history of the SEC.
Okay.
All right. So the SEC was founded after the great stock crash of 1929, where the need for federal regulation of securities became really apparent. You've probably read about it in history classes and perhaps even finance classes as well. And then there was 2 acts that were passed during the Great Depression, the Securities Act of 1933 and the Securities Exchange Act of 1934. And they created the framework for regulating securities, and then the Exchange Act actually created the SEC itself. Next slide, please. And we have a 3-part mission. Our mission is to protect investors, to maintain fair, orderly, and efficient markets, and to facilitate the formation of capital. And the formation of capital means sort of for business owners or people starting businesses or wanting to grow their businesses, being able to form the capital, so secure funds to sort of continue to build and grow their businesses. Next slide, please. We have 24 offices at the SEC and then also 10 regional offices. And this slide here just gives you an idea of some of the different types of work that we do. We've got an office of global affairs. We've got all sorts of offices here, and we'll talk just for a moment now about my office, the Office of Investor Education and Advocacy. We respond to complaints and inquiries from investors. These can come in by phone call, email. Some people will, print stuff out and mail it in to us. And then there's my branch of the office, and we do educational programming and educational materials, one of which is our website, investor.gov, which I encourage everybody to check out. And that's actually, if you just take away 1 or 2 things today from this webinar, I hope that knowing to go to investor.gov for information about saving and investing is one of those takeaways. So on an annual basis, our office processes 17,000 complaints, questions, or other inquiries from investors each year. And again, we have the investor.gov online resource. Next slide, please. So the SEC employs a little bit over 4,500 people. Most of those folks are in our headquarters office, which is here in Washington, D.C., right next door to Union Station. And again, we've got 10 regional offices across the country. We've got Boston, New York, Philadelphia, Miami, Chicago, St. Louis, San Francisco, Los Angeles, and I am definitely forgetting. We have Houston, and I'm sure I'm forgetting another 1 or 2 across the country. The majority of the folks that work here are attorneys, and about 60%, 25% of the folks that work here are accountants, and that includes roles like a forensic accounting, which is very interesting, and it's where accountants are going in and looking through books to see, if and where fraud or other crimes have occurred. And then 15% of the staff here is, in non-attorney and non-accounting roles. And that would include people like me who work in public affairs and outreach. We've got an audio video department. We've got, editors, things like that. Folks in public affairs and communications, our contracting office that works on the contracts that we work with folks that help us keep things running and help us do our work, all sorts of things like that. And I would encourage everybody to go to sec.gov/careers to look for information about our career opportunities, including internships. Next slide, please. And we have a couple of different internship programs. We used to have an internship program for high school students. It is not currently operating right now. I don't know if it'll come back in the future or not, but we do have internship programs for college. We have undergraduate programs for undergraduates, programs for grad students, law students, and also recent graduates. And you can get information about these programs at that sec.gov/careers website that I told you about. So the next slide just is a quick snapshot of the types of majors, fields of study that would go into sort of careers at the SEC. Barb, if you could advance to the next slide. There we go. So I'm not going to read all of these out to you, but it is quite varied. Cybersecurity, statistics, accounting, economics, international affairs, law and accounting, finance, marketing, things like that. So if you want to just take a quick look at this, and then we can move on to talk about making your money work for you. All right. So one of the really foundational aspects of making your money work for you is to think about and understand the relationship between debt, saving, and investing. So debt can be very expensive. And if you want to think about getting a handle on your debt sort of as early in your life and your career as possible, and really understand how to use debt prudently, and how to really understand when you're taking on debt, what it is exactly that you're taking on. Debt can be quite expensive. And, you know, these last few years, we've been going through inflation where everything is costing more. I don't know if you've noticed that, like your pizza order, or when you go to a fast food restaurant or go to the supermarket, everything just costs more than it used to. And that inflation that's happening right now is at a higher rate than it had been in years past. So one of the places where this is really obvious is with interest rates for credit cards. And the average interest rate for credit card debts as of today is 27%. Which is really, really high. Even just a month or two ago, it was 24%, which is really high. It's up quite a bit from where it was. So thinking about and understanding debt and getting a handle on it is a really important foundational step as you're thinking about having your money work for you. So savings help you establish and set yourself up so you can weather any financial shocks. So something like a broken cell phone screen, or, you know, you get a flat tire on your car. If you don't have an emergency savings set up, that can end up being a really big financial shock. That can set you back, so you have more time where you're having to sort of make up and get back to where you were. And investing is when you take your money and you put it to work for you. That is where you're thinking about your goals over the long term, what it is that you're hoping to achieve, and how can you have your money that you have worked for work for you to achieve those goals. Next slide, please.
All right.
No problem. All right, so we talked about this a little bit before, but you want to look at paying down and avoiding high interest debt, building up your emergency savings, and contributing regularly to a retirement or investment account. Next slide, please. Thank you, Barb. I really appreciate it.
No problem.
All right, so this is a quick snapshot of a sort of roadmap to building wealth. You want to think about some things like ways that you can improve your earning potential. So this could be thoughts about your school, that sort of major you pursue, or things that give you job qualifications, things like that. Thinking about finding a job that would maximize your income potential. And I want to share right here that isn't always a straight line. It doesn't always mean that you have to think about, you know, whatever is going to sort of make the most amount of money right out the gate. Although that is definitely something to think about. But my first job out of college, I made $22,500 a year. Just $22,000 a year, which was about $11 an hour. That was last century, but even then it was quite a challenge to figure out, you know, how to sort of make ends meet with that. But that job was with National Geographic magazine, and that is the position that really set me up for all of my different career milestones from back in the 90s to today. So it doesn't have to be, you know, always a straight line. Sometimes it's just thinking about really what kind of exceptional experience can you have that really sets you up for future future career choices and opportunities. Also thinking about living within your means at all stages of your life and career, being careful with credit cards here. And there can be sort of a lifestyle creep that happens. So one of the things that was actually great for me with my first job out of school was that I had to figure out how to live on this very, very fixed budget. And so I was able to do it. And then, you know, as I was earning a little bit more and more and more, I actually remember saying to a friend of mine, oh, you know, the food scene in DC is so great. You know, I'd been in DC for, you know, probably 5 or 10 years at this point. I said, there never used to be great restaurants like this. And she very gently informed me that there had always been fantastic restaurants in DC, but that I simply could not afford them and would not even dare to think about going to these places, that I was always thinking about sort of my trusty Julia's Empanadas and places like that I could actually afford. And in many ways, I wish I could get back to really sort of living with, you know, within my means in that sort of pure and beautiful way that I was able to with my first job here. And then you really want to think about saving and investing part of what you earn and setting that up as soon as possible, really when that first paycheck starts coming in, because then you're setting yourself up with this really strong financial foundation, and you don't notice that this money is not going into your checking account because it never goes in. So you want to look at things like setting up for sort of automatic contributions to a 401k plan or a savings plan, and you won't even miss it because you have set yourself up. So you're just building that foundation, and it doesn't feel like you're sort of making sacrifices or difficult choices or things like that. Barb, if you wouldn't mind going to the next slide. So here, as part of sort of you know, thinking about your wealth mindset, you know, we're going to talk just a little bit about needs versus wants. And I would love if anybody has ideas for a better example than the venti pumpkin spice latte, because I just feel like it's a very old and tired example. I would really appreciate to hear those. I want to update this slide. But needs are things like food, water, and shelter. I would argue that coffee is a need. I really can't function without coffee. I've just come to terms with it. But getting a sort of specialty latte that's like $9 or something is not in the need category. It's probably more of a treat. Thinking about things like just making food at home versus food delivery, or even something like picking up Taco Bell instead of having it delivered by Uber Eats, because it's a lot more expensive, but it's designed in this way that you don't quite see, hey, this actually costs a lot more than if I just like, you know, walked around the corner and picked this up myself. And even things like, especially as you're starting out with your career, thinking about your choices of where you'd live. Like if you're, you know, going to go live in some luxury high-rise apartment with no roommates versus thinking if there's, you know, is there something I could do that's a little bit more modest right now? And then there are areas and decisions that you'll make where it might be a want for somebody else, but it is a need for you. Or vice versa. And that could be something like a car. You may live somewhere where you don't really need a car. You can reliably get to work, get to see friends and family without a car. But for other people, a car is going to be a need. Those things will not happen otherwise. And so that's where, you know, you just want to think about these, you know, what are your needs versus your wants? And some other examples of this are, you know, a high-end smartphone versus a regular smartphone, streaming services, things like that. Next slide, please, Barb. Thank you so much for helping with this too, with these technical issues. So here we're going to talk just a little bit about the cost of credit. What we have here is somebody who is looking to furnish their new apartment that they're moving into, and their budget for this, or what they're planning on spending, is $1,000. You know, to get a sofa, maybe a couple of other things. You could either save up and pay cash for this, and then that's all that you've spent. You've spent the $1,000 for this and you're done. Or you could look to finance the purchase with a credit card and then pay those monthly payments over time. And this example here, the numbers here that you're seeing, are based on a 24% APR. But as I mentioned earlier, the average APR right now is a 27%. So these numbers are actually even a little bit on the conservative side. So if you were to set yourself up where you purchased everything on a credit card and then you just paid the minimums of $35 each month, that initial payment, $20 of the $35, so more than half, would be going just towards interest, just towards the privilege of borrowing the money, and only $15 would be chipping away at the principal. So over the course of this, you're looking at a total cost of $1,497.61. So you'd be paying $500 more than you did for the items that you received. And it would take you 3.5 years to pay that off. And I don't know, I mean, maybe think about what is your couch going to look like after 3.5 years, and you're still paying for that couch 3.5 years later. So this is just something to really think about, because whenever you're making a decision to put your money into one thing, whether or not you realize it, you're making a decision about where that money and your future earnings will or will not go. All right, next slide, please. We'll talk just really quickly about, even walking around in day-to-day spending decisions of putting something on your debit card. So it's money that's coming out of your bank account. Obviously, you have to keep a sufficient balance in there for that versus swiping your credit card and not paying off the balance in full each month. And it can become quite challenging to pay off that balance in full each month. And that can sort of creep up over time too. It can become this habit where you end up sort of paying for your lifestyle a year ago, 2 years ago, 3 years ago, rather than building and growing for, what it is that you're looking for tomorrow and next year and that sort of thing. Next slide, please. And here, this is part of the wealth mindset. This is us looking at making a major financial decision, purchasing a car. We're looking at two examples here, a $50,000 car and a $25,000 car. But I need to interject and share my personal thoughts on this, which is that I think $50,000 and even $25,000 for a car is so much money. And I live in a city where this has happened to me before. I don't have a parking space. And so when I walk out in the morning, I have seen my car get hit because it's parked on the street the night before. And it hurts a lot less when it's a more modest car than if it's a really, really expensive car. But my brother, sorry, if we could just go back to that last slide. My youngest brother is a mechanic. And I actually asked him a few months ago, what was the least amount of money that I could expect to reasonably spend to get a good used car. And he shared that a few years ago, you could spend $3,000 to $5,000 and probably get a really good used car. He's a mechanic, so he said, you need to make sure you have it checked out by an independent mechanic, but you should be able to find a really good car for that. As we talked a little bit before about inflation, things have just gotten a lot more expensive. So a few months ago, what he said was, realistically speaking, you could look for a $10,000 car. It might take you a little bit of time, but you should be able to find a good, reliable car for $10,000. So as I'm showing you these sort of binary options of like a $50,000 car or a $25,000 car, there are other options that you can think about too. So I just want you to think about that. So with this example of financing a $50,000 car purchase, you're looking at a monthly payment of $800 to $1,000 a month. And there would be nothing beyond that for saving and investing. Now, if you were to look at making this more modest car purchase, which I still think is really a lot of money, a $25,000 car purchase, you would be looking at a car payment of about $373 a month. And that would allow you to put $100 a month into savings and put $300 a month into a 401k. And if you are early in your career and you're able to figure out a way to be putting $300 a month consistently into your 401k, you are setting yourself up for like a really, really nice nest egg. And you are tapping into the superpower that folks in their teens and 20s and early 30s have, which is just the power of time, tapping into your youth and the fact that you've got all these years of earning and investing potential ahead of you. And you would also have another $66 a month that you could just spend, on whatever you chose to. So this is just an example of sort of how you can build a wealth mindset and think about your decisions today and how they're setting you up to sort of really crush it with your goals tomorrow and next year, 10 years from now, that sort of thing. Next slide, please. So we talked about this a little bit before. We'll just, touch on this really quickly, but setting yourself up with an emergency fund is a really good way to help you stay on track with meeting your financial goals over time. So the Federal Reserve did a study a year or two ago where it showed that the majority of Americans did not have savings to deal with a $4,000 unexpected expense. And that could be something like a broken cell phone or a flat tire on a car or something like that. And it would be a financial shock from them where they would have to go into debt or, maybe not even have a car that can get them to work, which can, really throw things off. So there are a couple of different ways that you can look at building up or starting an emergency savings fund. So you could look at one-time savings opportunities if you get any, a tax refund, for example. If you've got a tax refund coming in, you can do the jolt and set yourself up with a nice emergency savings. The same could be true for gift money if there's, graduation money coming your way or something like that. And then setting up a direct deposit for maybe $50 or $100 a paycheck. Next slide. Now we're going to transition into talking about savings versus investing. So savings is the money that you earn, but you don't spend. And investing is money that you may have to work for you. It's money that you make grow. Next slide, please. And why is it that we want to make sure that we're investing and not just savings? Well, we've talked a little bit about inflation already, and that's really the main driver with this. Interest rates for savings accounts, many of them are as little as 0.5% or maybe 1%. There are some high yield savings accounts out there that may be 4.5% or 5%, but it just isn't. That won't keep up with inflation over time. Your money will be worth less 10 or 20 years from now than it is today. And investing, allows that money to grow over in time, and through the beauty and power of compound growth, which we'll talk a little bit about in a second, that money can really start to work for you. So this is an example here of a Ford F-150 pickup truck that I think it's 1999 versus 2024, and the cost of the truck was $15,000 in 1999, and this year it's $50,000, and that's a really significant price increase. So just saving for this, if you were trying to save for this over time, you would not have the money that you would need for the cost of the truck today. Next slide, please. And I don't know, are there any questions in the chat or anything? Or Barbara, should we save that for the end if there's questions?
I'm glad you mentioned that. If people would like to add questions in the Q&A, that would be the best place for them. And you can go ahead and start now, and then we will have Nicole answer those at the very end of the presentation. So you're welcome to add those anytime.
Excellent. So I will talk a little bit now about investing for the long term. This is something when you are in school thinking about what you're going to be doing when you get out into the quote unquote real world, and when you're a young professional, you are in a powerful position where you can really avail yourself of this formula, which is making regular contributions to your investment over time. It really turns into some significant wealth building. So you want to think about starting to save and invest as soon as you get your first job, and try to keep that going throughout your entire career. And you want to be putting your money in, whether or not the markets are up or down. And one thing to think about when there's this sort of frenzy and there's a lot of stuff in the news where the markets are going down, you can think about that actually as an opportunity. Now, we're not fortune tellers and we can't see into the future, but you could think about that as, this is really a long haul for me. These shares that I'm looking to buy today cost less than they did yesterday when the market was up or something like that. So it can become if you're paying a lot of attention to it and you're putting your money into retirement accounts, it can be quite a ride when you're looking at that money, on a day-to-day basis. But really, it's the consistency of regular contributions over time that can set you up for some really building your wealth, building your nest egg. Next slide, please. If you're hearing rustling paper, it's because I'm looking at my notes here on paper, just to make sure I'm not missing any of the big points. So here we're going to talk a little bit about the power of compound growth, and this slide really illustrates the beauty and magic of starting to contribute early. So this is we're looking at a scenario where you're either looking to have $250,000 by the age of 65 or $500,000 by the age of 65. And there have been reports in the news over the last couple of weeks that I have really paid attention to, because my retirement is probably sort of close enough for me to see it, and it's maybe a little bit different for the folks on the webinar today. But it said that to sort of the news reports have been saying that to retire comfortably, you really want to think about having a nest egg of $1.4 million. So you really want to be thinking about this when you're younger. So to save $250,000 by the age of 65, if you're 25, that would be $104 a month. Which would be $52 a paycheck. You may not even notice that. And if you're looking to put it into something like a 401k or a thrift savings plan, you also wouldn't be paying taxes on that money right now. So it would come out to, it would sort of not be $104 coming out of your paycheck each month. It would actually be a little bit less than that. Now, if you waited until you were 45 or 55, that amount of money that you need to contribute goes up exponentially. At 45, you have to put in more than $500 a month. At 55, you're looking at $1,500 a month. And basically, you just want to double that if you're looking at your goal being $500,000. So setting yourself up for these contributions younger and really committing to doing it for the long term, you are just going to see your investments have the potential to grow with the power of compounding, which is really like a snowball effect where you may get 7 to 11% of interest in a year, and then the money that's grown, then it's compounding on a bigger amount. And there are ups and downs with the market. It can go up 20-something% in a year. It can drop down just as much in another year. But the S&P 500 has actually averaged a return over the last 50 years of just a little bit over 11%. And this example that we're looking at here assumes a 7% rate of return. Next slide, please.
Well, it doesn't want to advance.
Oh, no.
There we go.
All right. And we don't have to take too long here because we did already talk a little bit about the snowball effect, but here we are. So your money invested grows through compounding, and you can look at things like purchasing stocks, where that money can grow because the price of the stock can increase. Stocks also will sometimes pay dividends. So if there's a company and you own stock and they did really well, they may share some of that wealth with their stockholders by actually paying out dividends. And the dividends themselves can be reinvested. Bonds pay interest out periodically, and they return the principal at the end of a specific period. And those bonds can also be sold on the secondary market. And then funds, which have things like underlying securities, and those underlying securities can increase in values. Those securities can issue dividends that can be reinvested back in. There can be things like capital gains or other earnings that can be reinvested. So there's different ways in which stocks, bonds, and funds can increase in value over time. Now they can go up and they can go down, but this is just to talk a little bit how they can increase in value. Next slide, please. And this is an illustration to show what $100 per month with a 7% annual return, how that can grow over 40 years versus just contributing those funds. So if you see what happens, and this is a really good illustration of what happens with compounding and the power of compound growth. It looks in the beginning like it's really not that much of a difference. You're not really seeing a significant difference. You kind of have to, it's slow and steady wins the race. And then if you look, especially when you get to years like 22 and up, it really starts to shoot up, and there's a really big difference between that money that's been invested and the money that was just sort of socked away in a no interest account. Next slide, please. And this is an example of this is a snapshot of the stock market's performance over 30 years. And just like with life, progress in the stock market, growth in the stock market is not linear. If you look at this, there have been some pretty significant and wild swings up and down and up and down and up and down over time. You can even look at the date lines on the bottom and think about, oh, I know what was happening then. I know what was happening then. So, it's you can look at things like the housing crisis of 2008. There was the tech sort of bubble that burst in the early 2000s. We had a dip right around when the pandemic started, but you'll notice things rebound back up too. And there's an overall trend line of upward progression. And this is a pretty good example too of if you are looking at and paying attention to the value of your 401k account or something like that on a daily basis, it can be quite a roller coaster ride. So you almost want to figure out a sort of a real understanding of your goals and what it is that you are looking to achieve, and have sort of a steadfast detachment to it, so that you can really think about getting there and what it means to grow. Because there could be a strong incentive when you see this dropping to sell at that time. And then what you've done is you've basically locked in those losses. And it can be difficult to sort of come back from that, where if you had sort of stayed the course, or maybe looked at sort of rebalancing of a portfolio, but still continued to invest regularly over time, your money that you're putting in can grow with the market. Next slide, please. So these are just some sort of basics of investing, some investing terms to think about. And the reason why, so there's the concept of risk. Your money is safer when it's in a savings account that is, FDIC insured or something like that, but you're earning much lower in interest when you're investing in stocks, in the stock market, in companies, things like that. There is more risk. And so sometimes those riskier choices, there is a greater risk of losing from that, and also another risk of looking at it growing as well. But there are things that you can do to manage that risk, like asset allocation, which is where you're thinking about dividing your investment portfolio among different asset categories, which would be things like stocks or bonds or cash. And then also this concept of diversification, where you're spreading your money among different companies and sectors. So, you may be looking at investing in sort of the automotive sector, and that could be something like Tesla and General Motors and BMW or something like that. And then, where it is in terms of the types of investments that you're putting your funds in as well. Next slide, please. Are there any questions right now?
Let me look. There's one question about careers at the SEC, but maybe we can just wait on that one until
that sounds good.
To the end. Yeah. Mm-hmm.
That sounds good. So we talked a little bit about risk already. We can go to the next slide. And this here is just an example of, this shows you sort of the spectrum of lower versus higher risk assets. Like cash is a fairly low risk asset. Bonds are sort of more medium risk, and you can expect higher returns. And then you're looking at stocks, which are higher risk, and then you can likely expect with your long-term goals having higher returns. Next slide, please. This is talking a little bit about asset allocation, and where if you're starting out in your career today and you're looking at retiring decades from now versus someone like me who is hoping to retire, in the next 10 or 15 years or so, the places I would put my money and the places where you would choose to put your money will not look the same. You'll likely want to have a balance of cash, stocks, and bonds. And for me, being closer to retirement, I probably want to start shifting my stuff into slightly more conservative investments that have a little bit less risk. Next slide, please. I think it might need, I don't know why the pie charts aren't showing up, but this here, what this should be showing you, and sorry about that, is the difference between asset allocation for somebody early in their career and somebody later in their career. There we go. Yep. So
Okay.
this 2050 side, this is probably more matches what someone earlier in their career would be looking to do. And then the next pie chart, which should hope, there we go, probably reflects a little bit more. So, I wish I could retire next year, but somebody that is looking to retire next year, they probably want to have more of their money in bonds, which are more conservative, and less of their money in stocks. Next slide, please. Here we're just talking a little bit more about the risks of investing and diversification. We can move on to the next slide. And this here is a snapshot of the S&P 500 on a given day. And the red is when a stock didn't perform very well. The green is when a stock performed well. And the more green it is, the better it performed. The more true red it is, the quote unquote worse it performed. And this is just showing you on this given day that some of the big companies that we know are pretty big powerhouses on the stock market, they didn't have a great day. However, we know that over time they're actually doing quite well. So this would be an example of, you might see this and this might feel like not, oh, my portfolio really didn't do well today, but there is quite a bit of green on here. And so if you were diversified and you had your money, allocated amongst many different sectors, you probably would have done okay this day. And certainly over time, if you continue to hold shares of these larger stocks, like if you have your investment is in this index fund, these what are kind of these large red tech stocks would continue to do really well. You'd be bouncing back from that. So this is showing just sort of the power of diversifying with something like an index fund. Next slide, please. We'll talk a little bit about building wealth through your job. I want to make sure we have time for questions. And if folks want to drop questions in, please start doing that and we'll start chatting. Next slide, please. So there are different ways to build wealth through your job. A really powerful one is through an employer-sponsored plan. So that would be something like a 401k, also known as a 403b for some nonprofits. In the government, it's called the Thrift Savings Plan. And these are investment plans that have tax advantages. You have up to a certain amount of money each year that you can put in, and you don't have to pay taxes on that money. You will when you take the money out down the road when you're spending from that, but you don't have to put that in today. And so that is sort of lets you put a little bit more money in that can grow over time, and then you're paying taxes from that. But many employer-sponsored plans will have a match for it. And so if nothing else, when you're starting out with a job, or if you're in a job now, anything that offers a 401k, at the very least, you want to understand what the employer matches and make sure that you are putting in enough of your own money so that you're getting that full match, because otherwise you could basically be sort of cutting your salary, saying to your boss, that's cool, I don't want you to pay me the whole salary that you're willing to give me. And that's just, that's kind of just an easy win right there. And any money that you put into a 401k, that is your money. Some of the employer match money, there may be a vesting period where you might need to save for something like 3 years for all of it to be there. But any of your money that you put in, and at a certain point, any of the employer match money is yours. And if you go to another job, that account is still yours, and you can look at rolling that in somewhere else or keeping that account as is. There's different options. And then there's another tax advantaged way to save, which is through an individual retirement account. And you can open that regardless of whether or not your employer offers a 401k. Next slide, please. So there's two different ways that you can put money into retirement accounts, and they are each tax advantaged, but in ways that are sort of flip flop from each other. So in a traditional IRA or a traditional 401k, you would put that money in before your taxes, and that lowers your taxable income for the year. But then you would pay money on those taxes when you withdraw it. With a Roth IRA, you would put in your money after, so you'd pay taxes on it this year and you'd put that money in. But then down the road, when you're looking to spend that money in your retirement, that money will be tax-free. You've already paid the taxes, so it's tax-free when you withdraw it. Next slide, please. So tips for your retirement account: get started as soon as you can. And then look to increase your contributions and earnings over time. So if you were to get a 5% raise, you could consider bumping up your contributions to your plan, maybe by 2%. You still feel the 3% raise and you'll get a little tax advantage. Make sure that you're taking advantage of any employer matching that's out there. Do not leave that money on the table. You have worked for that money. Make sure that you're getting it. And set yourself up to contribute consistently over time. Whether the market is going up or down, you are in this for the long haul. And maybe think about when the market is down, it's on sale. You're getting sort of more value for your buck, and you're staying the course. And then think about and pay attention to the fees that you'd be paying. For most 401ks and employer-sponsored plans, the fees should be fairly low. But there can be fees that can really add up over time. Next slide, please. I keep wanting to go in and click this slide myself. So we talked about this a little bit. When you're switching jobs, that retirement, the money in that account is still yours. You can keep some or all in your former employer's plan. They may want you to roll it over into another account, but you can do that either through an individual retirement account or through you can roll it into a new employer's account. You can transfer into the new employer's plan. You can roll it into the IRA. You can do this, but I'm telling you right now, I don't recommend it. And if you do it, your future self will one day have a little heartache thinking about what could have been. You can take a lump sum distribution. And you can take it at any time with your 401k, but then you're not taking any of the advantage of that power of youth and time. And you will not only end up paying taxes, but you'll pay a penalty if you take that money out before you turn age 59 and a half. Next slide, please. We're going to talk just briefly. It's almost 7:30, so we'll just talk a little bit about avoiding fraud. And I'm going to share with you, I'll try to drop it in the chat if I can, a link to, we have a sort of mock video of fraud that we created for investor.gov, which as you watch it, really hits all of the highlights of tactics that fraudsters use. Next slide, please. But you want to just make sure that you're thinking about protecting your accounts, protecting, your identity and things like that, and being aware of some of the tactics that folks use when they're trying to scam you out of your money. So think about things like picking strong passwords, multi-factor authentication, maybe think about MFA apps instead of even the text verification, because your phone number can be like the SIM card. There can be like a SIM scam where suddenly this actually happened to a friend of mine last week, where somebody somehow talked the cell phone company into giving them a new cell phone and a new SIM card. And it was not my friend. And it's been a whole thing. It happens quite a bit. So this is something to think about. Next slide, please. And so this is the How We Trade Program mock video we have, but there's a couple of just key red flags that are pretty time-tested red flags to think about. If something sounds too good to be true, it really likely is. And if you're ever asked to pay for any investment opportunity with something like cryptocurrency or gift cards or wiring overseas, those are huge red flags. And those are all ways where when you part with your money, it's virtually impossible to get it back. It's just really odd that a sort of legitimate investment professional would ask that you pay them with a gift card or, to wire something overseas if they're, supposedly, I don't know, live in Philadelphia or something like that. Make sure that you're only using payment apps to pay vendors that you trust. And if you are being pressured to jump onto an opportunity really quickly, or if it's something that is sort of limited and they're saying this is only open to so many people, those are both pretty big flags that you really want to stop and pause and do your homework. And the more time pressure that you feel, that actually could be, you may want to sort of have the contrarian in you kind of stand up and pay attention and like really hit the pause button on that. And you can also check on investor.gov to make sure that the person that you're dealing with is a licensed and registered investment professional. We have a really good search tool that you'll see on pretty much every page on our website. Next slide, please. This is another plug for my favorite website, investor.gov. And when you do look up someone's, an investor professional's background, you'll see their license and registration, employment history, and any important disclosures. And this too, if you're thinking about working with an investment professional, you want to check them out. One, to make sure that they're legit, but two, you can get a little bit of a sense of if this is somebody that you want to be working with. And there could be something, you could even look for things like if somebody has hopped jobs as an investment professional every like 6 to 8 months or something, they haven't been at many places very long, that in and of itself could sort of tell you, I mean, it could potentially tell you someone's a real mover and shaker, but likely if they're, if it's a really solid financial advisor, there may be some sort of movement of different firm to firm, but not really quickly. If they're hopping around that, you may want to ask some questions about that and really think about that too. So there's a bunch of different ways that you could think about and use this website. Next slide, please. This is another tool on sec.gov. It's Edgar. This is a tool that allows you to look at whether investment products are registered. Scams often involved unregistered companies and unregistered investment products. So this is another really good place where you want to look up and make sure that you're dealing with legitimate investment products as well. Next slide, please. This is the final slide for the evening. This is different ways that you can contact the SEC from the investor and investor education side of things, or where you can report suspected securities fraud. Also, if you've got any questions, complaints as an investor, you can reach out to us at help.sec.gov. And our social channels are here at the bottom. Our website and then our social channels are here at the bottom of the page as well.
Great. Such wonderful information, Nicole. Thank you so much.
I know it was a lot. I could have talked a lot longer, but I'm sure nobody wants me to do that. And I really look forward to answering any questions as well.
Yes, we have a couple of great questions for you. I'm going to start with this one since I know most of the students on the webinar probably are very interested in this. So are there any colleges that the SEC specifically looks for their employees, their interns? Or is it important to be an Ivy League college, or what is it that you're searching for? What would be the best advice you have for students?
Yeah, that's a really good question. We do not look for people to have been at specific universities. I think the majors, like if you looked a little bit, if you saw, that we employ 60% of us are attorneys, another 25% of us are accountants. It's really more the field of study that you're in. And then we actually have an office called OMWE, because everything in government has to be some sort of acronym for something. It stands for the Office of Minority and Women Inclusion. And the mission of that office is to make sure that we are all doing work to make sure that more minorities and women are pursuing and excelling in careers at the SEC. And that with that, we even think about our outreach, both the recruiters here and folks from OMWE, and also the outreach work that we do within my office. We think about going, making sure that we're going to organizations of all different types. And for like colleges, universities, and high schools, we're really thinking about going to places that are not sort of like not the Ivy Leagues, right? So we do a lot of stuff with HBCUs. We will make sure that we're going to different parts of, whether it's virtually or in person, different parts of the country too. I have a colleague who was just in Kansas on a outreach bonanza a week or so ago. Another colleague who just left for Louisiana today. So I would say that we are not focused on specific universities or things like that. For us, it's really the fields of study.
Right. And can you elaborate a little bit more about what may make someone stand out from those particular different fields of studies, or something you can do to stand out to the SEC?
This will be thoughts from Nicole, not official and not particularly useful. I would not bet any money on what I'm saying answer, because I don't work in our recruiting fields, and I actually don't work in a position where I'm hiring here either. But I would say involvement in extracurricular activities that show sort of an interest and a commitment to some of the stuff that may lend yourself towards a career. So there's, I'll give you an example. There's a group called the Young Investors Society. It's a nonprofit that sets itself up so that high school students can start investing clubs at their own school. And you could either do it on your own, or you could reach out to a teacher and have the teacher sort of sponsor and make it an official club. And, I would imagine, and I don't know that this is necessarily true for somebody who's reviewing resumes at the SEC, but I think somebody starting something like that or being part of a club like that, and then pursuing something like a career in finance or accounting or the law, and then wanting to pursue something like working in the financial industry, or one of we call ourselves FIREAs, Financial Industry Regulating Authority. That could really speak to, this is somebody like you are really into this. And I think, grades are really important. I don't personally, I will say, I was not a straight A student at any point in my life. And I am very happy with the journey that my career has taken. So I would not beat yourself up too much about that if you're not, although I will say, it does not hurt at all. And working towards the best possible grades you can get is really important as well.
Perfect.
Did I answer the question?
Yes.
Okay.
I love this question.
Okay. Someone asked what a nest egg is, and I just want to apologize for that. I should have explained it.
That's the question I wanted you to answer. I love it.
And I just want to apologize for that. I know better. I should have explained that. So a nest egg it's an expression that people use to talk about like money that you want to grow. So if you think about an egg in a nest and what the mama bird and the papa bird are doing, they create this nest. And then they have an egg or eggs in it, and they spend work. They work on growing their eggs. And then this also ties into the world of saving and investing, because there's also this expression, which you guys may know. I remember like a children's story when I was a kid that talked about a woman who had all her eggs. Don't put all your eggs in one basket. And what that is talking about, which is similar, is that if you put all of your savings into one thing, like a single basket of eggs, and I don't know, I'm thinking of like you're in a wagon. I don't know why. This is a children's story. I guess I read when I was a kid. You fall off your wagon, or I don't know, you hit a bump in a road and all of your eggs are broken. If you had your eggs sort of in two different baskets or something, you would have been able to weather that financial storm. So a nest egg is, it is the money that you would put into an investment account, and that's different from a savings account. which is thing where you're putting money in, just you want it to grow by the money that you're putting in. But your nest egg, it's you're putting in and you're making these decisions and working on future goals because you want that money to grow over time. And
Great.
if that was a terrible answer, you will not hurt my feelings by letting me know, and I will work on getting it more concise next time.
We probably have time for one more, and this one probably could be the whole hour, but the question is, what should we look out for when choosing investments?
So this is a great question. You want to do what's called due diligence, which is one of those just terms where I'm like, all right, well, let's explain it. I mean, it really means like doing your homework and making sure that you're looking at the sources where you're getting your information from. And that's where something like investor.gov is it's a government source. If you're looking, if there's anything that has that web URL suffix of .gov, that means it's a government website, and you may find that you will have more unbiased information there, that it won't be a scam website or something like that, or something that's looking to really sell you because they're more interested in making money off of you than they are in having you make money over time. That's sort of a strong generalization, but that may be something that you want to think about. When you're choosing investments, if it's something like through a 401k or an employer-sponsored plan, you'll be given somewhere between probably like 5 and 12 options to read through of different types of investments. And it could be something like a fund that basically mirrors the S&P 500, which is an index fund of like 500 things traded on the stock exchange. And you could look at that. You may want to look at having some of your money in something like an international market, more or less conservative. You probably want to have your stuff in a mix. But one really great thing to do is to look at what's called a life cycle fund, where you are choosing the year at which this would probably be sort of your retirement year, or it might be like when you wanted to start saving your money. So let's say you wanted to retire 25 years from now, you could look at a 2050 life cycle fund, and that will make these decisions for you over time of the types of investments that will get you, it is thought will get you to a nest egg that is grown prudently enough, but sort of with enough risk over time to be where you are when you want to retire. And someone asked about what's better, in my opinion, stocks, bonds, or funds. So I would encourage you to think about some of do a little bit of research on investor.gov and get to know a little bit more about diversification, asset allocation, and sort of risks and stuff. And you probably really want to be looking at a mix of things. And one day, I like the index funds, and funds are a really good way. So you don't have to be choosing individual stocks or bonds. Those funds can be a really powerful vehicle for you.
Right.
And I think, were there any other questions?
I think let's see, we've got, okay, well, you answered that question. I think you're good.
Okay.
We did have one question about they missed the first few minutes, in which they were lucky because they missed our technical issues.
Yeah, honestly, you did yourself a favor, and I want to apologize to everyone. I'm so sorry about our technical issues. But it happens sometimes.
But we managed.
Yeah.
But what I'd like to tell the rest of our participants is that we will post this webinar on the NSHSS website in probably a day or two. So you're welcome to go on and be humored by our technical issues at the beginning, because probably all of our students could have handled this in some way, but we did try everything that Zoom recommended, I will tell you. And I don't know what happened or what occurred, but we made it through. We appreciate y'all muddling through with us. And I'd just like to thank our special guest, Nicole Shea, and also our wonderful collegiate council member, Kiara, for being with us tonight. And I wish you all a wonderful night, and hopefully we'll be able to turn off the webinar. So thank you so much for everything. And I hope that you'll join us for another webinar in the future. Thanks.
Thank you, everybody. Take care.